Welcome back to another episode of Bitfinex Talks. I'm your host, Ricardo Martinez. Today, I'm here with Pierre Rochard, a legendary Bitcoiner and the Vice President of Research at Riot Blockchain. Pierre, thanks for coming on the show. How are you today?
Doing very well. Thanks for having me on.
I wanted to start off talking about your recent article. I saw your article, Say Hello to Bitcoin, in Bitcoin Magazine on Twitter in the last couple of days. I enjoyed it. Do you want to elaborate on the schism we're seeing right now with the movement of Bitcoin, not crypto? It seems kind of like since the FTX thing popped off that we've seen a lot of Bitcoiners start really stressing this differentiation. Is this the decoupling that maximalists have been talking about for a long time?
No, I don't think this is it. I think that there will continue to be a lot of what I would characterize as conflation between crypto, Bitcoin, and centralized exchanges, as well as kind of the third pillar in the mix here. So I think that they've been mixed together for almost a decade at this point. I'd really point to 2013 with the emergence of more and more altcoins, as they might be called, or other cryptocurrencies subsequent to Bitcoin. And really the biggest one that emerged was Ethereum. And so in the piece, I described some of the differences in terms of what Ethereum is trying to accomplish versus what Bitcoin is trying to accomplish. I think, though, that even beyond just the engineering differences between Bitcoin and Ethereum, at the end of the day, they also have a lot of similarities. I think the biggest similarity is that both are trying to be money. Both want to be currency, right? And so as monetary assets, they very much are competing. And just as assets, point blank, they are competing for balance sheet, right? Everyone's balance sheet has a certain amount of assets, and in many regards, it's a fixed pie. So these are in direct competition. But what I really wanted to get into was, how are they differentiated? Why is it reductive to just blanket call everything crypto? And so calling Luna, Ethereum, FTX, Bitcoin, all with the same label of crypto, I think hides a lot of the differences, very real differences between these concepts. And those differences have vast implications for the people who are interested in accumulating them or trading them.
Cool. I'm going to change the subject a little bit. First of all, what's Riot Blockchain for the people that don't know? And then what are you doing as the Vice President of Research? Like, what activities are you up to?
Yeah, absolutely. So Riot is the largest publicly traded Bitcoin miner. We have a 750 megawatt facility in Rockdale, Texas. And we're now north of 7 exahash. So it is industrial scale grid mining here in Texas. We are also developing a site out of Corsicana, and that's going to be 1 gigawatt. So Riot is 100% focused on Bitcoin mining, but doing it in a way that is vertically integrated. So we are a construction company building our facilities. We are also self-mining, so we have our own Bitcoin mining rigs. We're developing new approaches to both air cooling and to liquid cooling with immersion mining. And we also have acquired an electrical equipment manufacturing and design company, ESS Metron. So we really see ourselves as the end product is Bitcoin. right? We're accumulating Bitcoin on our balance sheet, but the process by which we're doing that is a vertically integrated platform strategy of, okay, we want to own end to end the Bitcoin mining process. So that's Riot. I'm the VP of Research at Riot now. Before I was on the advisory board for Riot. I was on the advisory board for Riot for 3 years. And Jason Les, our CEO, invited me to join the company full-time earlier this year in order to, one, provide lots of education. I've been learning about Bitcoin for the better part of a decade now. I'm still learning about Bitcoin. I still learn something new about Bitcoin almost every day. But to share that knowledge with everyone, from the executive team at Riot to the wider employee base at Riot, and the investors in the company, as well as other stakeholders like local communities, policymakers, and the general public. So the education part of this, I think, is critical, because there is essentially an education gap in many regards between what people think Bitcoin is versus what it actually is. But also there's lots of curiosity. People want to better understand Bitcoin. They might have heard of it, but not really even have any preconceptions about it. They're curious about it. And so I think that using all of the knowledge I've accumulated over the past decade and helping distill that down to messages and education that helps people is critical. So the second part is the research part. So we came out with a research report in September in conjunction with Joe Burnett at Blockware, focusing in on transaction fees. This is an area that I think that there's been a lack of attention to, and also a lot of myths around transaction fees and what their purpose is and what drives them. So one of the myths is this idea of a security budget. So people will say, for example, that Bitcoin has a declining security budget because of the halvings. And there's a lot to unpack there, because one, the halvings are in reference to the subsidy, which is new Bitcoin being added to the ledger. That actually does not contribute to Bitcoin's security. So the only purpose of adding Bitcoin to the ledger through the Bitcoin mining process is in order to prevent what's called monopoly seigniorage. So monopoly seigniorage is the profits that you earn as the monopoly issuer of a currency. Bitcoin, by issuing the new Bitcoin through the mining process, it is a highly competitive process, so that there is no monopoly issuance, right? So it's very hard to run a profitable Bitcoin mining company, and Riot is able to do so due to the talent of the people who work here, but it's not guaranteed, right? We don't have a monopoly over the issuance of Bitcoin. There is a highly competitive global free market of hash rate. Anybody can start mining Bitcoin. It's open source. There's no way to exclude competitors in any way. So preventing seigniorage is why the introduction of or the issuance of Bitcoin happens through the mining process. Any other alternative would be centralized. There's no other way to do this. So the issuance, or the subsidy, as it's called, of BTC, that is not actually adding to the security of the network. Rather, what secures the network is two things. One is Bitcoin nodes that are verifying all of the protocol rules, and two is people holding their Bitcoin on private keys. right? Now, and it doesn't even matter if it's a third-party custodian or that they are self-custodying, the principle is the same, which is that the only way to unlock those Bitcoin is by providing a signature from those private keys. And so that's what provides for the security of that monetary asset. Now, with regards to transaction finality, I think that's what people are referring to. They use the word security because they don't understand the concept of transaction finality. Transaction finality actually comes from transaction fees, not from the subsidy. And this is confusing to people because the mining reward is actually the sum of the subsidy and the transaction fees. But the reason why a Bitcoin miner includes a transaction and a block is solely because of the transaction fee that transaction is paying, not because of the subsidy. The miner actually gets the subsidy regardless of whether they are including any transactions in the block or not. So the subsidy is irrelevant to transaction inclusion, and thus it's really irrelevant to transaction finality. That's kind of the other point of confusion that we clarify in this research report. The third is what the budget is. So the word budget is actually also misleading. So security is wrong and budget is wrong in this phrase. It's astonishing to me that people still use this phrase in 2022, but that's why we wrote this research report. There is no budget in the sense that there's no amount of resources that is the correct amount of resources to be putting into Bitcoin mining in order to prevent double spends or anything like that. Rather, it's a reflexive process where if transaction fees were too low, we only know that by somebody double spending. And by double spending, that would incentivize transactors to raise their transaction fees. And so it's anti-fragile, and you only need to raise your transaction fees in response to an attack from a censor, not in anticipation of one. So I would really liken this to the difference between essentially putting somebody on trial before they've committed a crime, just in case they might commit a crime in the future, right? That's the idea of, hey, let's have high transaction fees so that we can prevent double spends. To me, that's deeply misguided. That's a waste of resources. And so rather, what we should want to do is increase your transaction fee when you are actually being censored in response to the attack. That way, you're not wasting resources anticipating an attack that might not even happen. So that's the other point that we clarified in the research report. So there is no correct budget that you would know ahead of time. Rather, it's actually what is the cost of responding to an attack, not what is the cost of preventing an attack a priori or ahead of time. So yeah, that was a great piece to write with Joe Burnett, and we hope that it helps other researchers avoid these traps of not quite grokking how Bitcoin transaction finality works.
Okay, awesome. Like, I didn't think you were going to get into the weeds like that so early in the interview, but first of all, I wanted to say it sounds like Riot's business model is completely different from another player like Marathon, where they kind of subcontract out. You guys are vertically integrated and you own every component of the mining process. The other thing I wanted to say is your work on education for the Nakamoto Institute was instrumental in my understanding of Bitcoin and kind of wrapping my head around how it all works. But since you brought up the transaction fees and finality and also the subsidies, what are your thoughts on full RBF, and what are your thoughts on the tail emission debate that are currently going on in the Bitcoin world?
Yeah, absolutely. So the other driver of transaction fees, other than censorship and essentially trying to uncensor your transaction by bidding up your transaction fee. The other cause of transaction fees to go up is congestion, network congestion. Basically, the idea that there's more demand for block space than there is supply at any given point in time. And so the way you see this is by looking at the backlog of transactions that are waiting to get into the next block called the mempool. The mempool is a queue of transactions that are not confirmed yet, that haven't been included in a block yet, and they are rank ordered by the transaction fee rate that they are essentially willing to pay to whichever miner includes them in a block, or whichever mining pool includes them in a block. So this bidding up process can happen in a number of different ways. The two major ones are child pays for parent and replaced by fee, RBF. And child pays for parent is CPFP. That does not roll off the tongue as easily as RBF. There has always been a debate about zero confirmation within the Bitcoin developer, Bitcoin protocol research community. On one hand, it is very convenient to be able to rely on zero confirmation transactions. And so, for example, if you see a transaction in the mempool that is a payment to you as an e-commerce site, for example, then you take that TXID, that cryptographic fingerprint of the transaction, and you enter it into your accounting system as, hey, this is a pending payment, and so we can lock in the exchange rate. That is, that there's a lot of e-commerce merchants that ideally they would be using Bitcoin as their unit of account, but the reality is that they are converting the Bitcoin into dollars or whatever their local currency is, because their e-commerce website is displaying dollars to the customer, and they're only using Bitcoin essentially as a payments rail for moving value, which creates a problem where somebody could try to essentially game the e-commerce website and try to get a favorable exchange rate. So they send the payment in, and if the Bitcoin price goes down or goes up, that's going to change their behavior, and they might cancel their order or something like that and get a refund. And it leads to all sorts of complexity. And the complexity only increases when you have folks who are using RBF or, namely RBF, of replacing the transaction with a new transaction that has a new transaction ID, and potentially doing a double spend, although this is where we get into the debate of, is it really a double spend or not? Because they are just replacing a transaction that's in the mempool, in the backlog of transactions that don't have any confirmations. And so by design, you might say, hey, look, the Bitcoin protocol, it's not a double spend if it's in the mempool. It's only a double spend if it's, at least one confirmation in and you're doing a reorg of the blocks.
Yeah.
So we get into kind of a semantic philosophical debate there, but it really is about how convenient can we make Bitcoin versus what are the formal security assurances or transaction finality assurances of the Bitcoin network. And I think that that's going to continue to be a debate. It has been for the past decade. There's no, I don't think there's a right or wrong answer here. I think that there's really great arguments on both sides. Where I come down is just use Lightning if you are doing e-commerce and you need to lock in an exchange rate very quickly. Lightning provides instant settlement, and so that's a really great protocol mechanism. But the reality is that there's lots of people who are still in on-chain, habits, and that we're still early. We're still so early.
Thank you. And then about the tail emission for the miner subsidy. I've seen people like Peter Todd kind of arguing in favor of it, and then I've seen other people arguing against it. As a miner in the mining industry, like, where do you sit?
Yeah, so as I mentioned, historically, transaction fees have only ever gone up due to congestion, due to demand for block space being greater than supply. And in the research piece, we discuss why transaction fees have been very low over the past 18 months or so, which is that there was the SegWit soft fork in 2017 that activated, and that really got adoption 4 years later in 2021. Or, there was adoption leading up to it, but there was a tipping point of adoption in 2021 where blockchain.com, that has the largest self-custody wallet, they enabled SegWit. And so we saw a dramatic decrease in demand for block space, not because fewer people wanted to use Bitcoin, but rather because they were using Bitcoin more efficiently. So there is going to always be this back and forth between demand for block space increasing due to fundamental Bitcoin adoption by users wanting to transact, and then supply of block space increasing due to efficiency improvements from the Bitcoin developers doing soft forks, or wallet developers adopting soft fork technology, or layer 2 scaling technologies like Lightning and Liquid and Fediment and other various trust trade-offs of layer 2s, or even what I've heard people call layer 3s of custodial wallets, right? So I think that there will always be this oscillation. I think transaction fees will continue to be very volatile due to waves of Bitcoin adoption. Eventually we get to 100% adoption and transaction fees will find some equilibrium point. I'm actually, I am moderately bullish on transaction fees. So you'll hear some really super bullish people say, hey, look, transaction fees are going to be astonishingly high in the future, which I'm skeptical of because of the technology improvements that are adding effective supply to block space. And then you'll also hear people who are super bearish on transaction fees who think that they'll be extremely low. And I'm skeptical of that because of the demand side, that I think that Bitcoin will continue to have significant demand, and that there are trade-offs between, for example, on-chain and Lightning. So there will always, I think, be a preference towards cold storage on-chain, and that is still the most secure way of holding Bitcoin for the long term, and that Lightning will really shine as a payment system for day-to-day payments, kind of your checking account, but your savings account will always be on-chain, is kind of my view. So that means that as a miner, I think that Riot will, and whoever is working with us on providing hash rate to the Bitcoin network, will have this source of revenue going forward.
We've seen a lot of speculation recently about miner capitulation, and difficulty's been kind of like near all-time highs, and energy's been increasing in price. What's your take on that right now? Are we near miner capitulation, or do you think that we still have a ways to go for that to happen?
Yeah, I don't have a directional view on where we're going to be in the cycle. Kind of looking at the future, I can look at the past, which is, you're right, that there's tremendous pressure on the mining industry as a whole. Now, Riot has had a strategy that I think has essentially allowed us to emerge as a leader because of really great risk management. So Riot has controlled costs, has entered into electricity contracts that are really conservative and I think essentially preventing this massive increase in electricity prices to negatively impact the company. Other players in the mining sector have not been so cautious. I mean, especially around leverage, right? Riot does not have any material amount of leverage on its balance sheet, and it's really, speaks to an approach of, hey, look, we know Bitcoin is volatile, right? That's the number one criticism of Bitcoin, is its volatility. And so anytime that you're looking at investing or putting money into Bitcoin mining, or in saving Bitcoin as your money, you have to do it with by modeling and baking into your assumptions that, hey, this asset can go down a lot in addition to going up a lot, right? So Riot has taken that view, and I think managed its risk particularly well through the cycle. So the company is still growing and investing and building. We're expanding in Rockdale. We're expanding in Corsicana. And that, there's going to be opportunities to buy mining rigs at prices that are much lower than they were 6 months ago, 12 months ago, et cetera. So eventually there will be a bottom. I don't know if we're at it today, or if we were at it yesterday, or if it will be tomorrow. But I think that if we look at historical cycles, we're well positioned. Now, I'll just leave it there. I don't want to speculate on the future because, again, Bitcoin's very volatile. There's lots of risks, and Bitcoin mining is not like a risk-free investment, right? So it's an industry where, despite what others might claim, is like Riot is taking on risk, and so is everyone else in this industry. But we believe in this strategy, and it is paying off so far.
We've seen places like New York kind of like move to ban mining and pass legislation that's hostile to mining. And then we've also seen like this narrative that proof of stake is like a cleaner, greener way to run the consensus for the blockchain. We saw Ethereum do the merge this year. What's your opinion on this kind of climate attack vector for Bitcoin mining?
Yeah, sadly, proof of stake does not solve the double spending problem. Fundamentally, the problem that Bitcoin is solving is that you need to have some kind of ordering of transactions so that you know who spent the money first. And that way, the person who is trying to spend it again, their transaction can be rejected by the network as being invalid. And so that's the double spending problem. Bitcoin proof of work does this ordering of transactions by combining this proof of work hashing with a difficulty adjustment. Won't get into the nitty gritty there, but the idea being that we can prove using energy and time that these transactions were ordered in a particular way, probabilistically. Now, proof of stake does not actually solve this, because while in proof of work, the miners are committing themselves to one version of the ledger history, in proof of stake, there is no such commitment. And so the stakers can commit themselves to any number of different versions of the ledger history. And in order to prevent long-range attacks, there has to be checkpointing. And the checkpointing can be either by a set of developers or by a privileged set of staking nodes. But in any case, it introduces a layer of centralization, which kind of destroys the value proposition of having a decentralized ledger, because now you can have folks collude, you can have people exiting, and but also you can have stakers preventing entry into the staking quorum, and so staking is far more like a federated model of trusted third parties, rather than actually having a decentralized peer-to-peer network where there are no trust assumptions, like with Bitcoin and proof of work. So there are solutions to this problem for proof of stake that are decentralized. So, for example, researchers from Protocol Labs came out with a paper called Pikachu, which allows proof of stake networks to anchor themselves into Bitcoin's proof of work, so that they can be a layer on top of Bitcoin using Taproot. But also, you could characterize the Lightning Network as a proof of stake network that is on top of proof of work. And so, in my mind, Lightning and Bitcoin really have the best of both worlds. That you have the transaction finality of proof of work, and you have the anti-seigniorage technology of proof of work, and you also have the low energy consumption of proof of stake with the Lightning Network, where sending a payment on Lightning from one Lightning node to another really consumes an infinitesimal amount of electricity, arguably less electricity than a Visa payment.
This interview has been flying by. You've had some excellent answers. My last question for you is, we've seen a lot of detractors talk about mining farms as like a risk for centralization and maybe being pressured by regulators into only mining like OFAC compliant blocks or censoring transactions. What's your response to this?
Yeah, I think that there's no interest within OFAC and the wider global regulatory community in actually censoring transactions. So because they understand that the game theory here is working against them, meaning that even if a transaction is withheld by, let's say, a US-based miner, that any other miner in the world or mining pool in the world could include that transaction, and that there's nothing being accomplished by that. What OFAC is really focused on is the fiat on and off ramps. And so, for example, when you are depositing dollars at an exchange or withdrawing dollars from an exchange, that's really, and for that matter, depositing Bitcoin or withdrawing Bitcoin from an exchange, where the exchange itself, as a centralized regulated entity, has to verify if that Bitcoin address is on an OFAC list or not. And so that's really where the focus is on, because the reason why the focus is there is for a very practical point, which is that the exchange can seize those Bitcoin. The miners cannot seize those Bitcoin. Even if they were to exclude a transaction, they still can't introduce a transaction that takes the Bitcoin. Whereas the exchange, just by the nature of operating a custodial wallet, can seize the Bitcoin that are being deposited, from an OFAC address, or and we have seen this in practice, that criminals don't want to hold Bitcoin. Criminals are fiat maxis. They want to convert their ill-gotten gains into designer handbags and Lambos and yachts or whatever it is. And so they're always trying to figure out, how do I convert my Bitcoin very quickly into fiat and withdraw it. And so that's why they end up depositing their Bitcoin at exchanges. And that's why exchanges then end up cooperating with law enforcement to seize the Bitcoin. There's no reason why miners or stakers would get involved, because there's no way for them to seize those crypto assets or those Bitcoin.
Is there anything else that I haven't asked you that you feel is important for the audience to know?
Do you want this to go on for 8 hours?
All right, we could leave it at that. How can people follow you on social media and stay updated with what Riot's doing?
Yeah, absolutely. So follow me at Bitcoin Pierre on Twitter and at Riot Blockchain on Twitter. I'm also on LinkedIn, so find me there. And thanks for having me on again.
Indeed, man. I'd love to have you back, because I really only got to ask you about half the things I wanted to ask you. So anytime you want to come back on the show, you're more than welcome to.
Yeah, let's do it again. Happy to come back.